financial stability, mortgage lending, and macroprudential supervision in the UK and the US. And I was also fortunate enough to have many conversations with Alan about his other book that he's also presenting today, which reflects his very rich and long-standing career in the field of compliance and just generally risk management in banking, strategies for compliance, tool techniques, and challenges in the financial services. We are also very privileged in this event that is organized today by UCL in having two stellar contributors as discussants to the book, and the two of them are well known in their fields of expertise. And I will be introducing each of them individually briefly as we go along with the presentation. Dr. Anna Keller and Professor Chiu. And I have not had that many opportunities to interact with Dr. Anna Keller, but it's always a pleasure to read her very, very good contributions to the subject. But Chiu has been a friend and a colleague for a very long time. And again, it's always a pleasure to see them. Before I start on the substance of today's presentation, and it's quite unique to launch two books at the same time. And one of the things that I have got to appreciate with Alan over the years that I have got to know him is how his amazing work ethic and his amazing professionalism and rigor. I mean, I have supervised PhD students for many years, for decades, but Alan is quite unique. He was always keeping me. Usually you have to remind your students that they, the next submission, he was always ahead of us. And, that was really a tribute to how he works. So I'm not surprised that I'm not only asked to share the launch of one book, which was the product to the PhD, but two books, which is, we all know, is quite demanding. He's now a full-time lecturer at UCL. He has also been lecturing at Queen Mary. He has a very distinguished career in financial services, having been with RBS and then Santander. And he combines the public and private dimension to banking with the academic perspective. So it's quite unique. I always tell my students that an interdisciplinary perspective is very useful, and obviously the opportunity to combine theory and practice to come up with two books in the area are particularly important. Let me just say a few words about the first book, and then I will give the word to Alan. Because the first book was the result of the PhD thesis, and we had many conversations over the years. And it is clear that in the aftermath of the global financial crisis, one of the key regulatory responses to the crisis has been the advent of macroprudential policy, rightly called in the book macroprudential policy, sometimes also referred as macroprudential supervision, which sits really between monetary policy and macroprudential supervision. And the study that Alan did in his PhD thesis, which he then published in the format that now has become the book, is a very interesting and novel one, because he looks obviously at one of the key markets, which is a fundamental part of the tools that we use in macroprudential policy, which is the mortgage market, mortgage lending. And he looks obviously at loan-to-value ratios, debt-to-income restrictions, as well as other instruments, in order to reach a further and broader assessment at, what does macroprudential policy mean in the current context, and doing a very interesting comparative study of the US and the UK, which have actually followed very different institutional routes, one much more politicized than the other. The US route, as we all know, we are with the FSOC, the Financial Stability Oversight Council, has followed a much broader in terms of interagency composition and treasury chair than the UK with the FPC, which sits on a balance position vis-a-vis the MPC or the Bank of England. So the issues, of housing and financial stability, which were at the core of the PhD dissertation and at the core of the book, really touch a chord with all of us. I always say there are three areas of life that finance always touches upon all of us. Banks, because we all have a bank account. Pensions, because at some point we all have to deal with pensions either as contributors or eventually enjoying a pension, if we may. I mean, that's a debate for another day. And then, of course, housing and mortgages. We all either have a house or live in a house or rent a house. And some, fortunate enough, maybe even be able to rent houses to others. So there is this emotional attachment that we all have to the mortgage market, like it or not. And so for all many reasons, personal and professional, I was very, very flattered that Alan asked me to preside today a group of experts, and I'm always here to learn. On the book, on the subject of the book, I always tell my PhD students, but Alan is a special one, that they end up being the experts on the subject. So I'm talking to the expert on the subject on this matter. And without further ado, I'll say a few more words before introducing each of the discussants as well as the second book. I'm really delighted to have become your friend and colleague over the years. And it was a true honor to supervise a fantastic PhD that has become this book. That's always the dream of any PhD. And as always happens with your academic endeavors, you have made your dream come true. So the floor is all yours. And thank you very much for having invited me.
Thank you very much, Rosa. And hello, everyone. And thank you for joining us today. Before I start, I want to thank a number of people, and starting off with Professor Rosa Lastra, who I can, becomes a mutual admiration society, I can say was a most wonderful, wonderful PhD supervisor. And also Dr. Costanzo Russo, who provided great support as my second supervisor, and Professor Iris Chiu, who's been superb in helping and supporting me all the way through my early academic career, and Dr. Anat Keller, who was my first tutor doing my master's at UCL all those years ago. And thank you very much for agreeing to speak at this event. Also, all the folks at my publishers, Routledge, who have worked incredibly hard and who have been absolutely terrific and supportive. And in this area, last but not least, Lisa Penfold for organizing this event, and the UCL Center for Ethics and Law for being the hosts. But most importantly, I would like to thank my wife, Fiona, for all her love and support, and putting up with me, and also putting up with me declaiming my book using the ironing board in the lounge as the lectern for much of what I've said. I should add, ironing boards are absolutely great as lecterns. So let's look at the details of the Housing and Financial Stability book. We are in the midst of a housing crisis. In the UK, many people dream of buying their own home, but for most now, it remains only a dream. In 1991, 70% of those aged between 25 and 34 owned their own home. More recently, this number has fallen to only 9%, from 70% to 9%. The effect varies across the country. For example, first-time buyers outside London and the Southeast need a household income in excess of £45,000 to afford a deposit and a mortgage. In London, this needs to be well over £100,000. Since, let's call it 2009, real wages of the median worker has fallen between 3 to 5%, depending on which measure of inflation you use. And with all the caveats that apply to averages and national indices, UK housing prices have risen by some 35% over the same period. The demand for housing is driven really by two factors. As Rosa mentioned, the social and cultural expectations and aspirations that people have. And secondly, the availability of mortgage credit. This is a slide that I created using Office of National Statistics data, but there are other versions of it around. The supply of housing has pretty much fallen off a cliff from the early 1980s. The private sector builds more or less around about 150,000 homes each year. It varies from year to year. Housing associations and local authorities, which is that very black line all the way through, build a few thousand. Sort of the grey line, build a few thousand. Before 1980, local authorities, as you can see, used to build something like 200,000 homes each year. And you saw that, you can see there's a peak in the sort of the 1960s. This level of house building has dropped dramatically over the last 40 years. The consequence is that we have a huge deficit in housing dating back to the early 1980s, mainly due to societal changes. The UK needs to build something like 300,000 homes each year for the foreseeable future to accommodate these changes and make up for the deficit of housing over the past years. The report, independent report after independent report, dating back to Kate Barker's report in 2004, have really produced the same findings of what needs to be done in terms of building more homes. It's a question of whether much actually gets done in practice. However, the focus has been very much on getting people to borrow more. Government policies are very much geared towards encouraging people to borrow to buy their homes. And this has all sorts of deleterious consequences. In the words of Professor Rajan, easy credit has been used as a palliative by governments. This is cynically expressed in the phrase, let them eat credit. The rapid growth in credit has inflated property prices and has frequently been the cause of systemic financial instability. There is a strong correlation between monetary policy, rising household debt, house prices, and lax lending standards and mispriced risk. Access to mortgage lending has fueled this high level of demand. The consequential financial instability and root causes have been seen since the recessions of, say, the early 1990s and the banking crisis then. Following the most recent financial crisis, 2007-9, central banks have developed macroprudential policies and regulations. These are aimed at addressing this level of potential financial instability. These policies are aimed at stemming the rapid growth in credit before these risks crystallize and overbalance the banking system. Macroprudential policymakers have a range of measures, levers that can restrict and reduce the growth in credit. These include loan to value and debt to income restrictions on mortgage lending. The effectiveness of these policies is largely untested in Western democracies. There are significant doubts whether they can be used effectively. This is due to a number of factors. One is, could they actually be imposed, or would they be imposed in time in the face of, let's call it, economic and political headwinds? There's limited evidence that even if they were introduced in time, they would actually be effective. There are strong doubts about the political legitimacy of their use by central banks, where an overt intervention by an anonymous committee in an unelected organization during a credit and property boom may have the consequence of threatening access to the home of one's dream. And this has been pointed out by a number of people, including a former Deputy Governor, Paul Tucker. This all leads to the cliche of, the party, the punch bowl dance music, and that presents a problem in terms of macroprudential policy. In my book, I recommend greater use be made of existing financial conduct authority, conduct of business regulations. These focus on ensuring that the mortgage for residential housing is affordable, not just now, but also in the future. It takes a somewhat paternalistic view, and essentially it is the measures being used to protect individuals from overborrowing to buy property. Some people describe it as being protecting borrowers from themselves. There's no issue in terms of timing because these measures are always on. They attach themselves also to the activity of mortgage lending, not to the institution itself. And the result is that if they are used effectively, the actual process of mortgage lending is automatically caught. Coupled with the stress test rates of interest determined by the Bank of England Committee, the Financial Policy Committee, there's an element of future-proofing against rising interest rates. These regulations are aimed at consumer protection, and if enforced, they have the concurrent benefit of assisting macroprudential policy without any of the issues surrounding political legitimacy. Nevertheless, there is a high and unmet demand for housing. It is the failure over several decades to address the lack of supply of housing in the UK, which means that we are still faced with the risk of financial instability. It's ever present. The same issues also affect other jurisdictions, parts of Canada, Australia, the US. These can only be alleviated by a substantial increase in building more homes, sustainable over a decade. But these are political decisions, not for central banks, but the risks and solutions need to be highlighted. Finally, although it is not known where the next crisis will come from, history suggests that it will have credit and property at its source. It is important that the UK and other countries look broadly at what should be done in terms of policies, institutions, and tools to make the housing market, mortgage lenders, and borrowers more resilient against a future crisis. Thank you very much.
Thank you very much, Alan, for presenting briefly your book. Wonderful. And we will have now the opportunity to hear from Dr. Anna Keller, who is a lecturer in financial law at the Dickson Poon School of Law at King's College, and also a research fellow at the Center for Data Analytics for Finance and Macroeconomics. And previously she taught at UCL, and she holds a PhD from Queen Mary, so it's all in the family, as well as an LLM from the LSE. I think of particular relevance for the subject of the book that Alan is presenting today is that Dr. Anna Keller has her own book on macroprudential policy, which is the legal foundations of macroprudential policy and interdisciplinary approach. And I'm delighted that Dr. Anna Keller has also continued in her own research this interdisciplinary approach, which I think is so important. So without further ado, and giving thanks very much for her for contributing to enriching the event of today, which is already stellar with 2 books. So the floor is all yours, and thank you very much for being with us.
Thank you, Rosa, and thank you, Alan, for inviting me today. It was a real pleasure to read your book, Housing and Financial Stability, and it is a great pleasure to be invited to talk about it. It is timely to discuss the book, not only because of its publication in 2020, but also in light of recent news about introducing 95% mortgage for first-time buyers. And we know that the scheme is aimed at helping first-time buyers or current home owners to secure a mortgage with just 5% deposit to buy a house of up to, I think it's £600,000. And that provides hopefully an affordable route to home ownership for aspiring home owners. The Prime Minister announced that it would create 2 million more occupiers and would turn, I think the phrase he used, generation rent into generation buy, which, by the way, is a phrase that was initially used, I believe, by David Cameron in 2015. As the book observes, the aspiration for home ownership in the UK could be described as a cultural tradition. And the launch of this scheme in April 2021 comes alongside the existing Help to Buy scheme that has been extended to 2023, which enables people to buy new build home with minimum 5% deposit by using this equity loan of up to 20% plus a 75% mortgage. And let's not forget the holiday on stamp duty that spurred house demand. When it comes with warning from the PRA in 2020 that banks were assigning inappropriately low measures of risk to home loans, then you can really say that perhaps history is repeating itself. These initiatives exemplify how access to home ownership is always high on the political agenda in the UK, in the US, and in many other jurisdictions. So politics plays an important role in access to credit, and this has great implication, as the book suggests, on the design and implementation of macroprudential policy. In an interesting piece in The Guardian, Josh Ryan Collins, head of finance and macroeconomics at UCL Institute for Innovation, warned that this initiative will put Britain, in his words, back on course for a house price crash. And that the key problem is that these schemes, whilst they encourage the democratization of housing, can also push up, perhaps artificially, one might suggest, house prices. In fact, house prices rise at the moment at the fastest rate in 17 years. And the headlines are suggesting that UK house prices rose by 7.1% compared with a year ago, labeling the markets on the boil. So the problem is that by introducing these schemes, we trigger a vicious circle. First, there is a pressure to increase the number of people able to own a house. That leads to initiatives to encourage home ownership. And this in turn results in increasing household debt and house prices. And of course, when this happens, we may have a housing bubble, and eventually this could form into a financial crisis. Of course, when a crisis happens, then we need to impose regulatory restrictions on the housing market. And when we impose restrictions, that brings a reduction in home ownership, and we start the cycle again. Interestingly, warning signs against the government new housing schemes are coming not just from academics, but also from the industry itself. So the managing director of personal finance at UK Finance, we all know the biggest trade body, cautioned that firms have a duty to lend responsibly and consider the affordability of the mortgage in the long term, helping customers to avoid the risk associated with negative equity. So I think you know that something might be going wrong when it is the industry that is putting the brakes on making it easier to buy houses. Similar warnings also came recently from housing charity Shelter. But in the meantime, the average house prices is more than 8 times the average UK salary. Dr. Brener's suggestions and cautionary notes in the book are most relevant here. And in the next few minutes, I would like to examine the book through the lens of the government new initiative. The book suggests that macroprudential policy must act with humility and cannot be expected to eliminate the credit cycle. Here, the book suggests on page 37 that macroprudential policymakers appreciate that the interaction between credit and housing is not just a narrow economic assessment, but requires understanding of the housing market and why demand for housing exists and how it might be satisfied. How can macroprudential authorities do that? Well, they need to consider a broader range of factors, as the book suggests, such as supply of houses. In fact, if you read the book carefully, the book goes even further to suggest that in attempting to use macroprudential policy to suppress the demand for credit, the FPC, the Financial Policy Committee, should consider what steps may be taken to increase the supply of housing. And this will require long-term planning and involvement of a range of bodies responsible for housing policy. But the FPC lacks, as suggested, both the statutory powers and the political legitimacy to employ macroprudential policy to reduce the rapid growth in credit by increasing the supply of housing. I agree with Dr. Brener that such a policy would be highly political. The FPC should at least, as the book suggests, highlight the concern of limited supply of houses and the financial stability implication over the long term. Let's focus on this aspect, supply in the housing market. In chapter 8, Dr. Brener observes that the lack of housing in the UK presents a significant and continuing risk to financial stability. The scarcity of supply and property price inflation is coupled with increasing credit, and this qualifies as an area where macroprudential review and intervention is needed. Do we have an increase in supply of houses? Without resorting to empirical data, and for the purposes of this argument, the answer to that question is perhaps or likely to be negative, because private sector developers that are responsible for most of the building work in the UK have no incentive to increase the supply of housing to match the increase in demand. And why should they? After all, they generate profits from increasing prices, and prices will increase if demand increases, but supply doesn't match that. So I think that's simple logic, one that doesn't even require a career in economics. The book cautions on page 189 against the competition concern in the housing market, and rightly so. In the UK, the 8 large firms build over 50% of the homes and continue to expand. The book analyzes a wide range of factors that prevent increasing house building, ranging from a large amount of land suitable for development being tied up in option agreement to a severe skills shortage. The book suggests remedies to address these shortcomings, and I would encourage policymakers and academics to explore these further in the book. With increased demand, the intervention of the Financial Policy Committee may be needed, or further intervention. But this is, of course, not an easy task. As the book suggests, it's very difficult to know when to apply LTV, LTI restriction, and how to calibrate them. There are also many other costs involved, such as their social costs, the social and political legitimacy, leakages, as the book suggests, and difficulty in measuring their effectiveness, to name a few. The book provides in chapter 3 a very detailed account of the effectiveness of these measures and evidence from their implementation in Sweden, South Korea, Israel, Hong Kong, and New Zealand. This also brings us to another central proposition in the book. Assessing the ability of borrowers to afford mortgages, often perceived to be a consumer protection tool that can be used for curbing a mortgage lending bubble, and more generally contain the growth of credit in the economy, providing important support for macroprudential policy. The argument in the book is that the use of conductive business regulation is rarely mentioned in studies of macroprudential tools, but nevertheless may be effective in curbing credit growth and at the same time protecting borrowers. The book draws on the US approach to learn about the benefits and the limitation of the approach. Perhaps we can see first signs of change in thinking about affordability in a recent speech of the Bank of England Deputy Governor for Financial Stability that said the affordability measures had successfully restrained the build-up, and I'm quoting, restrained the build-up of more highly indebted households that would otherwise leave the economy and subsequently the financial system more vulnerable in downturn. So regulators may consider utilizing affordability for financial stability purposes, as the book suggests. Another theme that I would like to highlight, but by no means reflects the scope of suggestions in the book that could be applicable to the scenario we're analyzing today. The book advocates coordination across policies as an essential element of macroprudential policy. Currently, we have low interest rates, and low interest rate may encourage demand for credit, search for yield, and greater risk, and potentially threaten financial stability. The required coordination between macroprudential policy, microprudential policy, as well as monetary policy is only natural where there are inherent tensions between these policies. Finally, the book analyzes a key concern in macroprudential policy making, that of political legitimacy. If the FPC employs high-profile tools such as LTV limits, it will have to engage in a political debate and explain its action. To conclude my part, in its March 2021 remit to the FPC, the Chancellor highlights that the mortgage market is crucial to meeting the government's ambition that people feel confident to move, to buy, and to sell their homes following the coronavirus outbreak. The government is committed to supporting first-time buyers looking to access the mortgage market. Accordingly, in its assessment of the costs and benefits of its policy actions, the Financial Policy Committee is required, wherever practical and relevant, to take these considerations into account. But its primary concern, of course, is financial stability. To achieve this balance, the book emphasizes the need for policy coordination and learning from experience in other jurisdictions. In the minutes of its most recent meeting in March 2021, the FPC observed that the extension of the stamp duty holiday and other government schemes announced at Budget 2021 might continue to support housing market activity in the coming months, and banks were well positioned to supply the necessary credit. While the evolution of household indebtedness in the future would depend on the economic outlook, the FPC's mortgage market recommendations put in place in 2014 continue to guard against a significant increase in the number of highly indebted households. So for the time being, we're safe, but the drop might be waiting just around the corner. I would highly recommend reading this topical, important book, and I congratulate Dr. Brener for his thorough and well thought through work. And thank you so much for inviting me to talk today.
Thank you very much for those words and for having read and reflected upon the book from such an expert point of view as yours. We will also benefit from your own contribution to the subject, so thank you very much. But we're going first straight into the second book, and the book is entitled, as you know, Strategies for Compliance, Tools, Techniques, and Challenges in Financial Services. So we move from one area of financial stability and financial services to the tools of financial compliance, the tools of compliance, one that is related to another area of research and interest, both in his previous professional life and now his academic career, which explores very much the issues of compliance, ethics, and culture, which are actually central to how financial firms operate and should operate, particularly in the aftermath of the global financial crisis. And the book explores strategies for creating not only compliance cultures from a technical perspective, but in issues that he analyzes, he also looks at ways of fostering trust and confidence in financial markets, as well as an ethically compliant way of doing it. Something which in his work for the Parliamentary Commission of Banking Standards, as well as a couple of other chapters, including a common chapter that we wrote together, he has been exploring. He looks at whistleblowing in the financial services. He looks at examples from Wells Fargo to the mis-selling of PPI, payment protection insurance in the UK. He looks broader at issues of corporate governance, and it is really another major contribution to the subject in financial law. And without further ado, I will let Alan present the book himself.
Thank you very much, Rosa, and thank you very much, Anat, for your kind words and again, your insights as well. Strategies for compliance. We've seen one corporate scandal after another: Wells Fargo, Wirecard, Greensill, it just goes on and on. Many of these firms would have had compliance functions. In some cases, these would have been quite large teams. However, they appear, from what we can see, to have been largely ineffectual. And it's really the question is, what can be done to improve matters? First, speaking up. One of the key problems that boards, particularly non-exec directors and compliance staff have, is trying to find out what is going on inside the company. And what I've found and what people have seen is that there's always been at least one, and quite often a number of people who have known about the problems, but for one reason or another have not either spoken up or have not been heard. And this is a fundamental part of compliance. This goes beyond financial services. And an example of that would be the investigation into the wrongdoing at the Mid-Staffordshire NHS Hospital Trust by Sir Robert Francis. He found that even the local ambulance crews knew that they should avoid the Staffordshire hospitals and they should take patients off to Stoke if they could. Amongst other things, the investigation found that patients were neglected, they were left without food and without water, and in some cases they had to resort to drinking water from their bedside flower vases. And it is clear that people knew about these issues, but they largely kept silent, or if they did speak up, they had their voices quashed. But as I've said, even the regional ambulance crews knew about the problems. And there's, in many of these cases, you can describe it as being a complicity of silence. A number of reasons for that, many reasons, but there's a certain sort of psychological constraint on many individuals not wanting to be seen to rock the boat, not under pressure to be team players. And in some cases they did speak up and the information was passed to, say, a supervisor, but they either declined to hear it or they delayed acting upon it for a variety of reasons. They did not stand up and they did not want to be held accountable. Compliance in many of these scandals may have known about the issues, or they may have been so embedded in their own silo that they weren't aware of what was going on, or they did not understand the significance of what was being said. But again, like others, they may have just kept their heads down. In another non-financial services example, there's the Herald of Free Enterprise. This is a disaster, as some of you may recall, sank just outside Zeebrugge Harbor in 1987 with the loss of almost 200 people on board. You may recall that the ferry sailed out of the harbor with its bow doors open, and obviously the seawater flooded in very quickly. And no one on the car deck was responsible for ensuring that the car doors were checked and closed. And the captain on the bridge had no camera, so they couldn't see the bow, and there was no alarm about the bow doors. And the Marine Investigation Report found that previously a group of ferry captains from the company had previously raised this issue, and also the issue about vehicle overloading with the company senior management, but had been ignored. They also found that the board had no understanding of its own responsibilities and its need to ensure its oversight of what was actually happening. The second area is the problem of silos and information flows. This is a very big topic, but very briefly, you have structural silos and cultural silos, and sometimes both, where individuals see that their power exists by hoarding information and not sharing it. And let's call it the purposes of the organization itself are either not known or not valued, and people operate with a compartmentalized mind. The corollary of this is, in many cases, the directors and sometimes the group control functions insulate themselves or are insulated from disturbing news. And you have a culture where in bad news is suppressed and only a Panglossian good news is allowed through. This takes on to the next section, number 3, which is inward-looking and deceptive organizations. It's all too common that management exercise a level of self-deception. They have a narrow perspective and a certain blindness. You can sometimes see it in the language of euphemism, and this was clear from the report on the issues at Wells Fargo, where issues are disguised by euphemistic phrases, and what is really going on is suppressed by the use of language. You could describe it as being the employment of language which keeps thoughts at bay. Also, individuals have a high level ability to rationalize what they hear and have this level of wishful thinking, in which, again, at Wells Fargo, the report noted a culture of senior management optimism in which all problems were minimized. Also in this country, the investigations that took place into the collapse in 2007 onwards in the financial crisis found a high level of self-deception. And this can be best summed up by an answer given by one of the CEOs of one of the failed banks at the time, where he honestly believed that we thought that we were on the side of the angels. The fourth one is the ability to spot high-risk organizations. This is both an issue for boards, particularly non-exec directors, the control functions, including compliance, and also the regulators. And there's a whole variety of things you can look at. The business model, that was clearly an issue with a number of banks, and including Wells Fargo, and its culture, which I'll come on to a bit later on. Looking at the firm's purpose, its methods of governance, corporate governance, its leadership, and the environment which the organization operates in. If it has a high growth strategy, it has low or rapidly declining profitability, is dependent on cross subsidies, how the senior management and boards perceive their own level of personal accountability, if they perceive them at all. That risk can also thrive in where you have a highly competitive market or the business is on the verge of failure. All of this can drive management to setting extreme targets. It can lead to issues of misconduct and provide incentives for wrongdoing. Fifth one, compliance and corporate governance. Again, another big issue. There is an issue that I've seen that businesses quite often tend to regard the compliance function as a technical unit, which is called upon from time to time to provide advice. And this is reinforced in many compliance departments who actually see themselves in this role. The compliance officer, the compliance department see themselves as lacking authority and that they have no input into the business strategy, the product development and the firm's operations. The remedy for this, of course, is that the control functions, in this case, particularly the compliance department, need to be heavily involved in the business strategy planning, new products and changes in key business strategies. There's also a tendency I've seen in compliance departments for staff to focus on the detail of regulation. Obviously, the regulations are important and the detail is important. But if there's an over-focus on this, you get what I call the illusion of compliance, whereby the business goes on very much as before. And this is sometimes looked upon as being a sort of like a form of box ticking. It encompasses something even more worrying, something much deeper, which is the abdication of responsibility and the antithesis of establishing and demonstrating authority. And it's this element of authority, which is my seventh point. Authority really comes in two forms. There's the authority which the organization imbues the compliance department and other control functions with. And then there's also the individual's innate authority. The first one is relatively straightforward. Where does compliance fit within the firm's hierarchy? Who does it report to? The allocation of resources and so on. The second one is much more difficult. It's to do with obviously character, and it's also to do with the ability of the compliance staff to persuade as to what needs to be done. And this I described as having authority, but also having an element of latent power. The compliance department staff clearly need to have integrity, be dynamic, naturally curious, persistent, never letting go. If any of these things are missing, then nothing else will work. Going on to the eighth point, failures of leadership and ownership. One of the issues, again, that's quite common, particularly in large organizations, is that issues are allowed to fester for a long time. They're known about, but no one takes ownership for them. This could be due to a range of reasons, including just in general corporate inertia. But you could have bickering over who should take ownership, who should be bidding for resources, and so on. Compliance, I believe, needs to take an operational role. If no one will take responsibility, it must do so itself and essentially get the issue sorted out. And it's part of their key role. What can be done? Well, as I've said, one of the big issues is finding out what's going on. And there are a number of mechanisms for doing this. One I can mention is what I call the directed telescope. This actually comes from the Prussian General Staff in 1866 during the Prussian War with Austria. And you had a number of Prussian armies, each commanded by a prince of the blood. And they were not keen on taking orders or even telling what the Prussian General Staff what they were doing or what they were up to. These were princes with very long genealogies. So the Prussian General Staff, what they did is embedded very keen young officers within each of the armies, whose job it was to find out what was going on and to report back directly to the Prussian General Staff as to what was happening, so that at least that they knew what was going on and could take some sort of action. And this they described as being their directed telescope, looking straight in to the organization. There are many others. Compliance must ensure that the business considers all the stakeholders. It must actually do work to ensure that the culture is right within the business. This is a management responsibility. This is a board responsibility, but compliance have a central role on this, because if the culture is not right in a business, then nothing else will work. All will be dust. And the phrase that's quite often used, or I've used, is culture eats regulatory compliance. If the culture is wrong, nothing else will work. And it's important that culture is measured, and it can be done. There are all sorts of measures which I've used, including staff long and short-term sickness, staff going away repeatedly ill, staff training participation levels, particularly those who miss training sessions, operational failures, service outages, dealing limit breaches, goes on and on. However, many companies use measures which are too simplistic and too high level and are aggregated. And Anthony Zoltz, in his report on Barclays, said that in the culture information that provided to the board within Barclays at the time, all the indicators were shown as being green, everything was good, because at an aggregate level, the information was supplied at an aggregate level, everything was fine. It's a problem when you dig down, and you can dig down to very small teams, sometimes a trading desk and sometimes a small unit. And if you put these all on what's called a RAG status, red, amber, green, you can see the red lights flashing up straight away. You know where the problems are. And it's almost always to do with the manager, always. One of the things I found very useful, and I'll finish on this, is the staff engagement surveys. If done properly, you can and should get very high levels of response rates, 80% plus. And again, this will tell you a lot about what's going on within the organization if done properly. So these are my suggestions. I've highlighted the problems, and I have a number of, let's call it, practical solutions to these. I'll stop at that point and look forward to hearing what Professor Iris Chiu has to say on this.
Well, thank you very much, Alan. Professor Iris Chiu, who is a friend and colleague for some time, is professor of company law and financial regulation at UCL. And she has previously taught in King's College as well as Leicester, where she did her PhD. And prior to coming to the UK, she was a legislative draftsman and a state counsel at the Attorney General Chambers in Singapore. And she's published very extensively in our field on issues from directors' duties and shareholder stewardship and corporate governance, very much related to many of the themes that Alan Brener has published in this second book, as well as regulatory theories and governance in the financial sector, related very much to the first book. So she could be also discussing the first book. And also she has published extensively with Ian McNeill, who is another dear friend and colleague. And for many reasons, she's in an excellent position to discuss Alan's two books, but she's going to discuss now Alan's second book. And the floor is all yours, Iris.
Thank you very much, Rosa, for the generous introduction. And thank you very much to Alan for inviting me to discuss your book on strategies for compliance. And Alan and I are colleagues at UCL at the moment, and he's also my deputy at the UCL Center for Ethics and Law. And we all at the center are very proud today to host Alan's double book launch. It's a great delight to us and a great achievement for the center. This book obviously is one that showcases years of experience on Alan's part, and is a product of his reflections, his extensive experience in the banking sector, and his newfound love for academia, and his passion for seeing that the compliance role should be rejuvenated and really very much emboldened and reframed in this time. And so, although he's painted a picture of what are the problems in corporations that need shedding light on, and that need much more improvement in terms of how we deal with them, I would like to talk more about the gems of hope that he's planted in his book. So Alan's book positions compliance not only as an organizational role and a function, and this book is certainly not a descriptive study or a manual for how to do a job, but rather we are given a vision. We're given a vision to reconceive the compliance role as very professional, and indeed as one that is deserving of academic study and research. And this is because the compliance role is key to uncovering as well as addressing a lot of issues in the corporate sector generally, and not just the banking sector, although most of the examples in this book are drawn from the financial sector. And in chapter 1, and I partly quote and paraphrase, this is how Alan envisions the role of compliance. He says that the role of compliance should be a powerful vocal conscience within the firm to represent the voices that the internal organization of the firm does not hear sufficiently, such as those of the stakeholders and society. And compliance should provide imagination of thought beyond processes and rituals, so that compliance can provide first a moral compass for business and to take leadership in that role, and second, to act as an intelligent interlocutor between business and regulators in order to facilitate two-way meaningful communication and discourse. And I would add, reinforce public and social accountability of business. And that is the vision in the book, which is a very rich vision. And so compliance is an important social institution and not just one that is positioned in the corporation. And it is important that the role of compliance be supported by professional development as well as regulatory support and recognition. I think positioning compliance within academic research and giving it dedicated conceptualization and treatment also goes some way towards such institutional positioning. In this manner, Alan's book has contributed to important thought leadership for the professionalization of compliance and why this professionalization is necessary for society more broadly. The book benefits from a heavy dedication to steps forward, actually, and does not commit the usual academic mistake of dwelling too much on the past. There are many useful stories that are highlighted for warnings, but more in order to showcase how Alan sees as the steps going forward. So there is one chapter using Wells Fargo as a case study to showcase the deficits of compliance. And it makes one sad when one looks at how compliance had been silenced as well as siloed. And chapter 7 on the firm cultures also provides insight into how organizational culture can become toxic. And this can then sideline the role of compliance. And we saw, especially those banks involved in the selling of payment protection insurance, how culture was a very important component and aspect that compromised behavior. Compliance is both a distinct mission and integrated within the organization. And in this manner, Alan presents a roadmap for reconceptualizing compliance in terms of its internal organizational rejuvenation, as well as its external facing dimension to regulators and society. This book contains many chapters devoted to the internal rejuvenation of the compliance role. For example, one of the key suggestions was that whistleblowing processes should be improved, and whistleblowers must be treated with sensitivity and respect. This is an important organizational reform that connects with compliance monitoring of firm problems in general. And insiders can be a very useful source of information. But of course, they're placed under this dilemma of whether or not they ought to come forward. The book contains many practical takeaways in relation to compliance recruitment, how to get the right people into the job, the operational tools for compliance officers, such as having an overall risk map and heat map of issues that need monitoring. And it is important for compliance roles to be able to take on board that broader bird's eye view of what they do. Alan's own experience and reflections permeate these suggestions, including a survey of key areas of risk for financial institutions, such as in financial promotion, in cybersecurity, customer feedback, customer complaints, etc. Further, Alan envisages that compliance should have a fundamental role in training all staff in financial institutions in order to further their mission of ethical training at all levels of the firm. This is important and provides an organizational rejuvenation of compliance that is not confined to procedures and to siloed information channels and work. On the external facing dimension of compliance, Alan envisages the compliance role to mediate communication between firm and regulator in a more regular and mutually trusting manner, so that it is productive for both firms and regulators. The supervisory relationship is an important one and often a neglected topic in regulation theory. It is often described as regulatory capture in its negative terms, or as an adversarial type of relationship between regulator and regulated, much of which is seen in enforcement. But this itself is a topic that merits further study and development in terms of how compliance could be the bridge for a more mutually reinforcing as well as trusting relationship between regulator and firm. Alan also provides 2 chapters which tell of the stories where compliance officers have been directly fined or disqualified by regulators in the UK and the US. The surveys are useful, but I think I would have liked to see more reflections on these cases. And for example, do you think the FCA has provided optimal signals to compliance individuals in relation to what the regulators' expectations are for them? And are there enough incentives for compliance individuals to do their job at this very high level and at this level of responsibility? How should we understand the impact of the enforcement actions in shaping compliance professions' perceptions of their own roles and development? Would it be a morale dampener, or would it be timely discipline? As there are a number of regulators involved in the US, such as DOJ, FinCEN, and the SEC, I'm wondering whether there are any comparative insights that can be drawn from their approaches in terms of what the FCA may be able to learn, and whether some approaches may be harsher than others. One running theme I see is that compliance officers can fall short if they feel constrained by business decisions or organizational structures. But how far should compliance officers be responsible for failing to overcome these constraints? And what principles should we draw in delineating those boundaries of responsibility? I think they remain rather difficult questions, even though we envision a conceptualization of the compliance role, and we hope that people taking on these roles take it with pride and with a much broader sense of responsibility and social accountability. So I hope Alan will continue to develop his thoughts on the compliance profession, especially in the broader context of being an internally placed institution that has the potential to gatekeep many corporations' moral directions and social consciences. This is ultimately an important social institution, and I think the book has made a very clear point by putting this forward. And this is a very important contribution to thought leadership in this area. So let me finish by once again congratulating Alan on the successful publication of 2 books. It is a great achievement indeed, and as I mentioned, we at the Center are very proud of this achievement and very proud today to be celebrating with you. Well done, Alan, and back to Rosa.
Thank you very much for those very good comments, and also for outlining and emphasizing what I'm sure will be a stellar contribution of Alan to UCL and to the Center of Ethics. Alan, before we start the Q&A, part of Iris' comments were questions to you. And obviously just her questions will take the whole Q&A. So, but if you just want perhaps to just pick one of those questions, and before I give the floor to the audience who is eagerly waiting to make their own comments and suggestions, you may just want to answer one of Iris' very challenging questions and important questions. And it's your choice to which one of them you want to answer first.
Thank you very much, Rosa. Thank you very much, Iris, for your kind words, and also your insights into what I've written. I think if I picked out sort of one particular aspect, is the let's call it the regulator's perception of the compliance function and how it should operate. And the answer is that I don't I'm not aware that there is one regulatory perception of compliance. I think it is very variable, depending on the regulator, depending on the individuals involved. Again, it would be useful, very useful, I think, for a dialogue between regulators and at least a representative group of people in the compliance or senior compliance roles, to actually let's call it achieve an understanding as to what the expectations were on both sides. And I have actually been involved in these, but it is some time ago since I last saw this done, and obviously things have changed since then. But yes, definitely, I think there is an opportunity for both compliance officers and regulators to get together to actually better understand the expectations and actually what is doable.
Very much. And now we have a number of questions. I say that we had a question from someone who you all know, Pat McCoy, Patricia McCoy, professor in Boston in the US. So I don't know, Lisa, if we can make Patricia a speaker so that she asks the question herself.
I so wish I could be with you in London. This is such a landmark achievement, Alan, and congratulations. Alan, you and I in past years have had long conversations about the tensions in financial stability regulation of mortgages. And in the United States, the major way that this tension has manifested itself has to do with access to credit for people of color, and specifically Black and Hispanic borrowers. We have had increasing attention to a very serious racial wealth gap in the United States. And for the majority of Americans, if they have wealth, it is from home equity. And so gaining access to the home ownership market is a very important way of addressing the racial wealth gap. That gap has also been increasing, no surprise with our past president. And so one US policy response was to create a number of prudential and consumer protection limitations on loan underwriting, but not to impose a leverage ratio. In other words, not to have a cap on loan to value ratios, because poorer aspiring homeowners don't have large down payments. And I think the US is an outlier in taking that position, but I'd love your thoughts generally on how to navigate the tension between these two goals, financial stability and distributional justice for people of color.
Thank you, Patricia. This is absolutely a key point. I do spend a whole chapter on the basis for US housing policy, and it's been a theme, as you know, in terms of racial justice, from at least the 1960s onwards, with let's call it peaks and troughs, say the least, from a very, very low base before that. There are definite issues in terms of let's call it the affordability routes, and there's an important role for the Consumer Financial Protection Bureau in the US in this regard. But there's an even more important role for both state, city, and federal governments in terms of what they do. And I have, as you can see, both the UK and other jurisdictions, I have big doubts that simply throwing more credit at the issue is the way forward. There are other steps that can be done. I can expand at some length on those, but it does come down to both federal, state, and local governments to actually arrange the building of houses and the financing of them at an affordable level for individuals that have been disadvantaged now and in the past, and simply throwing more credit at will only store up problems for the future.
I'll just say one last thing, which is there's been some really interesting empirical research in the United States about how to underwrite and design mortgages so that they are what we call sustainable, so that the homeowners are able to perform on them. And unfortunately, those mortgages have not reached scale, and that is something we need to do as well. So again, my congratulations.
Thank you very much, Patricia. It's always lovely to see you, and I look forward that we can meet in person in the near future. So we have a number of questions, both in the chat room as well as in the Q&A. And I received also from Lisa a number of questions that were sent to her already. So the two books have generated a huge amount of interest. So in my privilege as chair, let me just pick one of them. On whistleblowers, a subject which always raises a lot of debate, I find it astonishing, the question says from Dominic Lindley, that the FCA fails to gather any structured feedback from whistleblowers on their experience of whistleblowing. What kind of information or data points should we be looking at to determine whether the banking sector and regulators are moving in the right direction?
Thank you, Rosa, and thank you, Dominic. Again, a very good question. The answer is I cannot speak for the regulators. I do not know what they do with regulatory information that comes through the whistleblowing approach. Clearly, in the most recent letter by the FCA chairman to the Treasury, improvements in whistleblowing was highlighted in the light of various problems with LCF and others. So obviously there is work to be done, and that's recognized by the regulators themselves. I do think, and I'm absolutely certain of this, and I've seen this, that at corporate level, whistleblowing should go up to the board, and it should go up to the board undiluted. I have a rule of thumb from my own experience that pretty much any report that goes up through more than 2 layers of management gets so diluted that it loses its impact. And it's important that whistleblowing information is delivered to the board unfiltered, so they can see precisely what the complaint is, what the issues are, and obviously then it's the management's opportunity to respond directly to that. But it is a huge insight for boards, and I assume this is the case for regulators too, to see what is actually going on. Clearly this takes time, and it takes time out of non-exec directors, but it is such a fundamental area in terms of understanding what has happened, because too often whistleblowers are dismissed as being sort of sour grapes, an axe to grind, whatever cliche you want. And that may be the case for some, but other cases there is core information that needs to be interpreted and understood.
Thank you very much. Now I'm going to group 3 questions together. One is by Martin Hooper of Linklaters, and the question is, how do financial institutions strike the right balance between individual accountability and avoiding blame culture? The second question by Rupert Simpson at PwC is, how can compliance attract the right people to challenge bankers when the status and rewards are so unevenly split? The third question by our colleague David Llewellyn at Loughborough University: do you believe that the culture of a financial institution should be a central supervisory issue? So 3 different questions in a way grouped together for you to challenge or answer them in whichever way you think best.
Right. Well, thank you very much for Martin and Rupert and David. The blame culture is quite prevalent in almost all organizations I've seen, both as an auditor going way back, as a regulator and a compliance officer. But the key issue is to ensure that those who are actually responsible are also accountable. Okay, and responsibility and accountability, unfortunately, in many cases, is never matched. And if you look at the evidence given just by, for example, Tracy McDermott, who was the head of enforcement at FSA and then interim CEO at the Financial Conduct Authority, to the Parliamentary Commission on Banking Standards, she said that the regulator would investigate based on the evidence from junior and middle management, and they would follow this through. But then the trail almost always petered out when they got to this, before they got to the board and to the senior management. And the issue is that blame would focus on these junior and middle managers and not on the senior managers, so they wouldn't be held accountable. And to the credit of the senior managers and certified persons regime, brought in as a recommendation following the Commission's report, it's an attempt to redress that balance. And I discuss this at some length in the book. And also in another book chapter that's published last month. But an important topic where you need to have responsibility and accountability that actually coincide. On the issue of finding the right staff, a very, very important point, Rupert, and one again which I cover in the book. Find the right compliance staff is absolutely critical. They need to operate, obviously be professional, they need to have sufficient authority, they need to know the business very well. Very, very important. It's particularly important that they understand the business operations and the financial drivers. And personally, I've actually found many of the best compliance staff actually come from operational areas within the business. They just know it very well. They need to be very tenacious and never letting go. We've seen quite a few issues where the issue was uncovered, and for whatever reason, the management were able to convince the control functions and sometimes the regulators that things had been remediated when they hadn't been, and some checking would have uncovered that. Also, it's quite important that the compliance staff need to balance out using their good judgment, and that they don't start to see the business as the enemy. And again, I've seen cases where some of the compliance staff start to see the business as an adversary, and they see the business as, when they write a report, what I call a gotcha attitude. We've now found you out. And again, that's the wrong attitude. So it is a case of finding the right people and managing them in the right way in cooperation with the business, provided they have the expertise, the professionalism, the tenacity, and the right judgment and culture. On David's question, absolutely fundamental. Yes, without the right culture, everything is dust. The whole purpose of regulation and compliance will fail without the right culture. What I do know is that very few businesses have one culture. They have a whole range of cultures, and it's important that both the senior management and the control functions and the regulators are able to identify these weak points, whether it be a trading desk or an operational unit of some sort, and that's actually addressed, and it can be done, and cultures can be changed. But it's very rare to find one business that has a vampire culture that permeates all parts of it.
Very good. So now we're going to move to questions on mortgages. And I will group a couple, conscious of time. On mortgages, this is by Dominic Lindley. How should regulators tackle the issue that when they tighten macroprudential or regulatory rules, this results in customers being trapped, becoming what known as mortgage prisoners, and then exploited by having the rate increased? And the other question, which I will group together by Rafael Cohen Almagor. Congratulations, Alan, as everyone else congratulating you on a wonderful achievement. What governments can do to facilitate affordable housing in London, New York, Tel Aviv? Are these mechanisms universal or country specific? So those two questions, just to move from one book to the other.
Another one, yes. Right. Dominic, I haven't actually looked at the issue of mortgage prisoners. I'm closely aware of it. I know there is a real issue. And it's a particular issue where, let's call it, the debt is sold on. There are solutions to this. It can be done. It is a potential consequence of regulatory intervention, but there is a commercial solution to it, I'm certain. But the honest answer is I haven't looked at this specifically. It's not one I've addressed. Very happy to talk to you and others about that offline, or probably online, but not in this meeting. In terms of the issue from Rafi, there are a number of issues. One is that it comes down to fiscal measures. What is the taxation regime? Because that's very important in terms of the let's call it the local issues and how property is taxed. The other element is how the profits of land development are shared out. Who gets the profits? Because in this country, one of the reasons why housing is so expensive is that the land itself is very expensive, much more expensive than many other countries that I've looked at. So there's an issue in terms of let's call it who gets the profit on land development and how that's allocated. There are also issues which I talk about in the book, which are let's call it are not my inventions. There are a whole series of very good reports that look at this in terms of the role of the state and local authorities and housing associations in developing and providing affordable homes. There are issues in terms of the supply of labor. There are issues in terms of the supply of actually building materials, and that much of the building, certainly in this country and other countries, is what are called very old-fashioned. Someone in the 19th century would have recognized, was still recognized, and they're still carried out in very labor-intensive ways. To what extent can you end up with modular systems where the building is largely done off-site and then brought in sections and constructed? There are issues to do with planning, but this is highly political, and there is as you know, a government white paper in this country on the subject. All I can say is that the information that I've seen is that there are something like 1 million homes which have planning permission and have had planning permission for some time, which are not being built. And you can only question why that is the case. So planning permission is important, but it is not the key point. There are other points which are much more important. And it will vary from area to area. One of the Australian cities, the issue there was the foundations on which literally the city is based and the ability to find sufficient space to build out. There are issues in terms of zoning laws in the US. It goes on, but these are local ones applicable to each particular place. So I don't have a solution for every particular jurisdiction, but I have seen reports on each of these jurisdictions which does suggest ways in which these problems can be addressed. Thank you.
Thank you very much. And the last question, conscious of time, because we have to finish promptly at 17:30, so in 4 minutes, goes back to the compliance book with a question that caught my attention because of the reference to the line of duty. But before doing that, let me say a comment of my own. In discussions that you and I, Alan, have had with Charles Goodhart, what your answer to one of the last questions reminded me is that he says that though innovation has taken place in many other areas of finance, when it comes to mortgages and particularly to the building, We are back to the bricks and mortars of the 19th century. And if someone was to wake up 100 years ago, still will recognize how houses are made. And a lot of the mechanics of mortgages remains very much the same, notwithstanding, of course, the process of securitization. But back to the bricks and mortars, a lot of innovation may happen in future, but the truth is has not happened yet. But the question that got my attention, just to finish on something that even people that do not know a lot about compliance will relate to, is to what extent is a compliance division / role within a regulated industry akin to the fictional professional standards unit AC-12 in the recent popular BBC TV series Line of Duty. Of course, this assumes that you have seen Line of Duty, but anyway, here you go.
The answer is I draw a complete blank on this. We don't have a TV and I haven't watched it, so I honestly have no idea. But the role of compliance is and other control functions is central, very much dependent on the organization in question. Whether compliance is part of a risk division or whether it's part of the legal team doesn't actually matter that much. The key thing is is compliance, how is it perceived within the organization? It needs to report direct to the CEO, needs to be the chief compliance officer or director, needs to be a member of the executive committee, and the chief risk officer needs to be on the main board if it's definitely in financial services. The compliance department, in terms of dealing with risk, needs to understand, let's call it the approach that risk takes, and things such as risk appetites and percentages. These are not applicable to compliance. So compliance is adherence to the rules and regulations. It can't work on percentages and appetites, but it can be discussed and it can be agreed. The same thing with the legal teams. I used to run part of the legal team at Santander, and you have, let's call it, different mindsets between some of the lawyers and some of the compliance people, and you act as sort of a mediator between the two, as an interlocutor, as Iris Chiu said, trying to use similar language, the right language, to interpret one to the other to make certain people understand. And that is a key role that compliance has in terms of taking, let's call it, regulatory speak, turning it into language that will resonate with the business, and also taking information and let's call it dialogue from the business and interpreting it to the regulator in terms that are meaningful to the regulator and mean something.
Well, on that note, we're going to finish, and I will, in my privilege as chair, take the opportunity to thank again UCL, in particular Lisa Painful, for having so ably arranged this afternoon, Routledge for having published your books, and of course, Iris and Anat for having enlightened our discussion together with all the illustrious, many of them distinguished attendees. And the final thanks to Alan and to Fiona for having supported Alan, and to your father, Leon. And I hope that we can continue to see many double or triple lunches in future. Knowing you, maybe the next is a quadruple, but in any case, it's always a pleasure to work with you. You know how much I enjoy and have enjoyed it over the years. So I look forward to a proper toast, in person, since you cannot do a virtual toast, but allow all of us to join in thanking you for this presentation.